Yo, welcome back to Dadvestor. It's been a while. I've been really busy with my business, but everything is going pretty great, and I'm really learning a lot. So I wanted to go over what I have focused on with investing. Now, most of you already know what I do, but some of you don't, and hopefully I can get some new people to kind of check it out and see what I'm doing and maybe even learn something, or at least hopefully get some takeaways that aid you in your journey. So what I'm trying to do is build a monster portfolio that produces, passive income. So I call it the Dragon Portfolio because it's a monster portfolio, and the D reminds you it's dividends, and the G reminds you it's growth. So dividend growth portfolio. So and you can argue with me about these ETFs because they're not super growth heavy, but especially with these drawdowns this year, but everything dropped. So long term, it is a growth ETF. So I love the Schwab. I love SCHD, as I call it. I bought back into it after the split, and when it came down, I bought more. In my main account, this is sort of my side account, so I'm just kind of replicating what I'm doing. And I do hold other ETFs, Vanguards and stuff, in my my actual Dragon portfolio, but I'm starting to build it here, and I figure this is the whole point. This is the 3-part strategy that I wanted to turn into a system, and I think I have a pretty good system now. So if you're just joining us, this is the time. I don't have that much in this position, but I'm dollar cost averaging into it, which I think shows up somewhere around here. I missed it, sorry. There it is. So every day I buy $5, and 5 times 20 is $100 a month, excuse me. So every month I'm putting $100 in here, and I'm spreading out to capture a good average. And I'm doing the same thing in the VIG, although I don't know, did I sell out of this? Maybe I'm not. I did sell out of it, and then I forgot to cancel the order, so I bought $5 of it. So, but I'm in that couple thousand in my main portfolio, so it's good to have it. I'm just focusing on JEPQ and SCHD as my favorites. I have thousands in here, and because of the price drop in a couple months ago, I have subpar average cost, right? So it's I got it for more than it costs now. So I'm buying more now. I bought a lot today because I was thinking of doing covered calls on it, but on second thought, it's not a good deal because it's just not worth it. I don't want to lose my shares. So what I might do is sell puts, and then if I get assigned, it'll improve my overall cost anyway. But I can't afford it, so that's not going to happen. Eventually, that would be the part of what I would want to do, but maybe the premiums just suck on these, so maybe it's not worth it to wheel them at all. But speaking of the wheel, that's my primary strategy. So I'm doing that on Bitfarm, I'm doing that on Misty, I'm doing that on Marnie, which I don't necessarily recommend. So do your due diligence and make sure that you're okay with risking whatever you're risking. I'm okay with it. So I'm also, let's see, I guess that's pretty much, those are the underlines I'm doing for the wheel. I added Bitfarm for fun because it's super cheap. So it's a good example of like a kind of solid. It's not the best company, but I think it's fine. Because it's so cheap, it's not a big deal. But again, like, do your own research because you might be terrified of doing this, and don't do it if you're terrified. So I'm selling that, and I'm selling covered calls on it. I'm selling puts and calls, and the puts are easy to explain. Basically, if the price stays in the green zone, I win. If not, I lose. But the cool thing with the wheel is if you lose, you end up owning the shares, and then you can just turn around and sell a covered call on it, or go out in time, get a better price. So that's why it's called the wheel, because you can do both directions, and you just turn it. You keep turning. Every week you have something you can do. Misty, I'm doing the same thing, puts and calls, because I own 200 shares, and I want to own more, and it's cheap enough to where I can buy whatever that is of it. Marnie, I already own some, But the covered call, it's the reason I'm not promoting this is because the covered calls are so bad. So it's not worth it. And there's not enough dates to trade with. So I'm going to wheel out of that and then totally sell out of it for a profit. And so that's my second part, right? The first part is the dragon, the second part is the wheel, and the third part is the hedge. So this is the VIX hedge. It starts here, and I have these positions. And when I started this, I didn't really understand what I should do, and now I do. And so what you should do is only open these when the volatility is low, because then you get a really good price on it, like this one. I'm also switching from call debit spreads like this to put credit spreads like this, because put credits or puts or put credit spreads is basically the same strategy I do with everything. Everything is a put. I sell a put. The reason, so this is a hedge within a hedge, because it sounds like unnecessarily complicated, but you sell and buy. So you sell the put and then you buy the put lower to hedge your losses. Because if you're wrong and you just sell the put, with a VIX, it's just a big thing where you can't really you can't own it. So it's just an options instrument. So anyway, I got it for a good deal, and it hedges my portfolio against volatility, because the VIX is the volatility index. And so if the VIX, and it always does, spikes, that's because the market is crashing. And the crashes are always temporary, at least as far as we know, and hopefully that will be true always. And if not, then we have other problems. But periodically we have spikes in the VIX. And during those spikes, even just in the past year, these spikes, you can see the high in this tiny spike here is 28, right? So if you have these hedges in, when you get a big spike like this, it goes to 65, you can make a ton of money. Now I cap the money, right? Because I do hedged credit spread, but that's because I'm making so many of them and I want it to be cheap, sub $100 per position. Hopefully $80 or less. So some of these are like $30, $40. Let's see, how much did this cost? So it's a $400 position minus $320. So I got it for $80. But it's kind of a big position. So in the future, what I've learned is you want to have a ton of positions and you want them to be tiny. You want it to cost like $30, $40. Because then you can have a lot of them and it's not a big deal if some of them fail, because you don't always get those spikes. But they'll hold you in place as a safety, and then you can go big on the SPX positions. So I did, and all of them were profitable. That's why I don't have any SPX positions, because now is not the time for me to open a new one. Tomorrow I might. So when there's a small pullback in SPX, right? So I'm going to use SPY because there's more data, and we can look at the charts. But SPX you can't. But they're the same thing, the S&P 500. So if we look at this properly, you can see that selling a put spread on it now isn't really the time, because it's coming way up. Honestly, if I was super trader heavy, I would do a call, and I'd sell a call instead of a covered call. It'd be a call spread because I don't own it and I don't want to own it. And but I would get the same spread where it's like a green zone and a red zone, and the green zone will be down, because most likely it's going to come back down closer to this sooner or later. And I would hope sooner as a pullback, and then when it comes down a little bit, maybe consolidates for a while like this, consolidates here before jump up, or consolidates here before jump up, consolidates here before jump up. These were all kind of like politics crushing us. So, but I mean, look at that. This is all what happens. So after a big pop up, you get a few days where it's ranging before the next pop up. Sometimes it just goes up, but I wouldn't want to put a position on after a pop up, and then I put it up here and then it drops all the way down. I wouldn't want it to drop down. I put one here and then I get out here, and that's the strategy. So that's what I'm going to do. I'm going to wait. and I'm going to put them on. And if I'm wrong, where SPX keeps dropping for a while, then I'll just cash out on these, and that will cover it, and then I'll close the SPX position. But all my SPX positions, similarly, are relatively small. And then they're hedged here, so they're even smaller. And my goal is for these, because these are cheap, and then the green zone is so big, this covers a lot. So my goal is when volatility hits us, I actually make a profit, even though my SPX positions are bad. And then when it doesn't hit us, I just make a bunch of money on the SPX. And the smaller these are, the better, as long as I can get a good spread on them. So anyway, so the wheel is my number 2, and it goes in. And then the hedge is my number 3. And long term, I just want to have I just do the wheel and the dividend growth. And I probably wouldn't do the hedge too much because it's kind of a lot of work. But now I figured it out. It's not as bad, but it's the most. If you want to trade and have fun with it, it's probably the best deal because you can do something every day. Make a small position, close some, see what's going on. Maybe make more and more and more, and have shorter term ones. But I enjoy the wheel so much because it's pure options without all these extra hedges. And it sort of naturally hedges itself, right? Because you can buy the underlying. So so then it becomes more like closely tied to investing because I could just wheel things I want to own. But I'm just not there yet. And for small accounts, you need these extra strategies to increase your growth. Anyway, a fourth strategy I didn't really talk about is like a 0DTE, 0 day, or so a same day trade with options. I'm not super confident in this one because we're kind of stalled right now, but this has been the same price for like the entire day. I opened this at like 10 o'clock and you can see, yeah, it's basically been the same since like 10 whatever when I opened it, and then it came down, it came up, and it came down, it came up, and realistically I just want it to stay at 50 or 589, maybe 588. Because I made an Iron Condor. So the Iron Condor lives, it's just not that, the utility isn't that great. So, but yeah, I love playing ranges, but it's just not that reliable. So part of that is I like hedging using the VIX better, but you can't do that on the 0 days. So this is what I got. Yeah. But I just greatly prefer doing it this way because with like a wheel, it's just so much, I don't know, it just feels more stable and kind of more fun because you can roll each side. And on Robinhood, you can't really roll an Iron Condor, you can't really roll a spread. Maybe you can, but like the last time I tried, it was super weird and you have to break it up and it's not efficient. So that's why I like the hedge, because you just set it and leave it there, and then you either close it or you don't. So, all right. That's what I've been doing. It's been pretty successful, and I've been grinding my way back up. But you know me, I want that 100K. I want to be wheeling at 100K and playing easy mode. Once you hit 100K, Charlie Munger says it's easy mode. So get to 100. Let's go. Peace out. Keep it real. Happy hunting.